Most people believe you need a large, expensive property, perhaps a sprawling apartment complex or a commercial building, to generate serious real estate income. There's a common perception that big money requires big properties. But what if I told you that some of the biggest, most overlooked cash flow secrets are actually found in the smallest properties? This isn't about sheer size. It's about strategic thinking, maximizing potential, and seeing value where others don't. Today, we're going to fundamentally shift your perspective on what a small property can achieve, showing you how to transform it from a simple asset into a powerful cash machine. The biggest problem lies in a common blind spot. When many people, whether first-time home buyers or even seasoned investors, look at a small property, they often see its limitations first. A small house might be viewed solely as a starter home with limited space, or a compact duplex dismissed as not having enough units to generate significant returns. They see square footage rather than income-generating potential. First-time buyers focus purely on shelter, while some investors might overlook the strategic versatility inherent in smaller, more manageable properties. The common mistake is failing to consider the multiple income streams a small property can support, or how strategic modifications can dramatically enhance its value and cash flow. People often buy properties based on what they are, not what they could be with a focused strategy. Experienced investors approach small properties with a completely different mindset. They understand that real estate value isn't just about the physical structure, it's about the utility and income it can generate. The core principle here is maximizing unit economics and asset densification. It's about getting the most financial output from every square foot. This means looking beyond the existing layout and asking, what alternative uses or configurations are permitted here? How can I create additional income-generating spaces within or adjacent to this small footprint? This involves a deep dive into local zoning laws, understanding regulations around accessory dwelling units, ADUs, basement conversions, multi-unit splits, or even specialized rental niches. The goal is to identify hidden potential for additional living units, unique rental experiences, or services that can dramatically boost cash flow from a seemingly modest property. To help you apply this investor mindset, we've developed the Keystone Cash Flow Accelerator framework specifically for small properties. It's a clear, structured approach to unlock their income potential. Step 1. The zoning and permitting deep dive. Before you even think about swinging a hammer, thoroughly investigate local zoning ordinances, building codes, and permitting requirements. Can you add an ADU? Is a duplex conversion allowed? What about short-term rentals? This foundational step determines your viable options and avoids costly mistakes. Step 2. Strategic value-add identification. With zoning insights in hand, scout for specific value-add opportunities. This could be converting a basement into a separate apartment, transforming a detached garage into a studio, adding a tiny home in the backyard, or even creating private room rentals with shared common areas. Think creatively about how to create independent living spaces or specialized rental offerings. Step 3. Market-driven conversion and niche targeting. Don't just convert space. Convert it for a target marketing. Who are you trying to attract? Students, traveling nurses, remote workers, tourists, or long-term tenants. Looking for compact, efficient living? Research local rental demand and tailor your conversion and finishes to that specific niche. A well-designed, functional space for a specific demographic will command higher rents. Step 4. Financial feasibility and ROI calculation. This is where the numbers do the talking. Meticulously calculate the costs of renovation, permitting, and potential property management. Then, project the potential rental income from your new unit or diversified streams. Compare the total investment against the expected increase in cash flow to determine your return on investment. A small property becomes a cash machine when this equation clearly demonstrates profitability. Let's consider a realistic example. Imagine a first-time homebuyer, Sarah, who purchased a modest 2-bedroom, 1-bathroom house in a desirable neighborhood. The house had a spacious, unfinished basement with a separate exterior entrance. Instead of just using it for storage, Sarah applied the Keystone Cash Flow Accelerator framework. First, she researched local zoning. Step 1. She discovered that ADUs were permitted in her area, provided they met certain size and egress requirements. Next, she identified the value add. Step 2. Converting the basement into a self-contained 1-bedroom apartment. She sketched out a layout with a small kitchen, bathroom, and living area. Then, she considered her market niche. Step 3. Her property was near a university and a local hospital. She decided to target graduate students or traveling medical professionals, designing the unit to be modern, clean, and efficient with good internet connectivity. Finally, the financial feasibility. Step 4. Sarah secured a renovation loan, estimating conversion costs at $40,000. Her mortgage for the main house was $1,500 per month. After conversion, she rented the basement apartment for $1,200 per month. Suddenly, her effective housing cost dropped from $1,500 to just $300 a month. Not only was she building equity in her own home, but she had a robust cash flow stream, significantly offsetting her primary housing expense, turning her starter home into a profit center. The power of turning a small property into a cash machine extends far beyond immediate income. This strategy is a formidable tool for long-term wealth building. Firstly, that consistent rental income significantly accelerates your equity growth. It allows you to pay down your mortgage faster or free up capital for other investments. Secondly, you're leveraging a smaller initial capital outlay to control an appreciating asset. While generating cash flow, the property itself is likely appreciating in value over time, providing a dual benefit. This strategy helps diversify your income streams, reduces your personal financial burden, and creates a foundational asset that can be used to fund future property purchases, provide financial stability during economic shifts, or serve as a substantial retirement asset. It's about building a robust property portfolio, one strategically optimized small property at a time. The lesson here is clear. Don't underestimate the potential of small properties. Size is not the primary determinant of real estate wealth. Strategy is. By shifting your mindset, applying a structured framework, and focusing on maximizing every square foot for income, you can turn a modest property into a powerful cash-generating asset. This approach isn't about hype or speculation. It's about smart, practical, and sustainable real estate investing. We encourage you to look at every property, especially smaller ones, through this lens of opportunity. Research your local zoning, identify potential, and run the numbers. With the right strategy, your next small property could be your biggest step towards financial independence through real estate. If you found this insight valuable, please like this video, subscribe to Keystone Property Advisors, and share your thoughts in the comments below. We're here to help you make smarter property decisions.